All right, to our next company, Plenti, also posting good results. Let's get some further detail. Chief Executive Daniel Foggo joining us now. Daniel, good to see you.
Good to see you too. Thank you.
All right, sum it up for us then. How would you look at your results?
So we delivered our results for the year to 31 March today, and we're really pleased with the results. There's no doubt for lending businesses over the last 12 months, there's been a lot of change going on. Obviously, the interest rate environment's changed somewhat, and so one of the key input costs, interest rates, have gone up. Despite that, we've actually driven really strong results. We grew our loan portfolio 36% year on year to $1.8 billion. And most importantly, we drove an increase in our cash NPAT profitability that went from $500,000 last year to $4.5 million this year. So overall, it was a result we were very pleased with.
All right, just looking at the share price, so you've had a good bump today. I think you're up close to 15%. Look, it has been a difficult ride for shareholders over the past few years. Do you see this, perhaps you're at a turning point?
Look, I think sentiment definitely changed around financial services businesses, fintech businesses, and no doubt a lot of that was driven by concerns around interest rate movements. I think we've got to, a long way through the increase in interest rates, and we've actually proven through these results that we've been able to pass on to our borrowers the increase in funding costs. So we're certainly seeing sentiment change, and hopefully over the next 12 months, we'll continue to be able to put runs on the board, and there'll be a better understanding that actually we can pass on changes in funding costs to our customers and drive profit growth.
Where are you seeing that growth in your sectors at the moment? Which ones are standing out?
So we're in three lending verticals: automotive finance, renewable energy, so that's solar panels and home batteries mostly, and the personal loan market. There's no doubt about it, the automotive market is a very large market in Australia. There's over $35 billion of loans funded every year. And so for our business, with $1 billion loan portfolio in automotive finance, there's still a long way for us to grow. That's not to say we don't still see really exciting growth opportunities in renewable energy and in the personal loan market. In renewable energy, we launched, just over a month ago, a new platform we called Green Connect. That's really exciting. It's making it easier for households to purchase home battery and solar systems, join a virtual power plant, and get the finance all together. So we think that's going to be quite key in terms of driving growth there. We've also seen a very supportive federal budget, encouraging, which is going to put money towards.
Well, I was just about to ask that. Obviously, with that support they're seeing, and obviously this is a huge growth area. You only have to look at the Australian suburbs at the moment to see the number of rooftop solar panels. So, how far can you take this? And I guess beyond Australia, are you looking at that point too?
Or to answer the first part, the last part first, no, we're very much focused on the Australian market. There's still a vast amount of opportunity for us to grow here. In terms of where we can take things in the renewable market, there's definitely a long way to go. Yes, we have a lot of solar panels on roofs here, but very low penetration of home batteries. And that is what the federal budget is really trying to encourage. If we want grid stability, if we want to be able to store the power we generate during the day from solar panels, we need home batteries, and the penetration there is low. What's really interesting is when you put in a battery, it's obviously a lot more expensive. That increases the need for finance, and clearly that's very beneficial for a business like ours.
Personal loan segment, what are you seeing going on there at the moment? Obviously, where interest rates are at the moment and household budgets under extreme pressure. What's your outlook?
Well, maybe slightly perversely, a higher interest rate environment actually leads to more demand for personal loans from good credit customers. So in the last 12 months, we've seen the personal loan market grow about 20%. And that's after a few years of it actually reducing during the sort of COVID period where there was a lot of fiscal stimulus. So we are seeing good demand for personal loans. We're a prime lender. The average credit score of our customers is very high. Our credit performance in the last 12 months was exceptionally strong. An annualized loss rate of 70 basis points or just under, which compares very well to the broader market. No, we think that that's still a very large segment of the customers we want to fund in the personal loan market. We've invested quite heavily in our direct-to-consumer presence in Australia in the last 12 months, and at half on half, we grew those originations 50%, and we think there's a long way to go in terms of continuing to penetrate there. Let's not forget, the banks still have a very strong market share in the personal loan market. So businesses like ours that can drive, a better customer experience, offer, an easier, way to take finance, and offer good value. There's still a lot of growth for us.
So do you see that growth in terms of taking it off the big banks?
Do we see it in terms of, I think We'd like to broaden the market as much as taking it off big banks. If you make it easier for people to obtain finance online, then we'd like to expand that market. And yes, it might be taking it away from credit cards, it might be taking it away from BNPL, but certainly we've seen that erosion of bank market share, and to the benefit of fintechs like Plenti.
Your retail investor platform, give us an update on that.
I'm glad you asked. We've got a retail investor platform called the Plenti Lending Platform. We've attracted over 26,000 investors onto that platform. It's now funded over $1 billion in loans. We passed that milestone in the last year. Pleasingly, we've paid those investors over $90 million in interest. Every investor's received every amount of interest in principal. And we really put a lot of focus on continuing to develop that over the last 12 months. In particular, we opened up a new market called our notes market that provides investors with a better return, and it also has allowed us to recycle some capital that we have invested in our ABS transactions.
So, you began there with a number of records with your loan portfolio, originations, revenue. Is that sustainable?
Certainly, in terms of outlook, what we communicated in our results today is that we do expect to increase the growth in originations that we achieve, that we can expect to continue to drive loan portfolio growth. So, as I said, we closed the period at $1.8 billion. We expect that to continue to grow, and we also expect to increase our revenue. Revenue in the last 12 months was $143 million. Our outlook is that we expect to achieve over $200 million in the year ahead. So there's still a vast opportunity for growth in our business.
What are the greatest risks you're facing at the moment?
Look, I think in the last 12 months, investors have really focused on what do funding costs do, and I think we've proven that we've been able to continue to drive cash impact growth with higher funding costs. So a lot of that risk is behind us, because we're also seeing lenders change their rates very quickly if there is a change in funding costs. When we look forward, definitely the credit environment is something that we're very cautious about. We've been very prudent in terms of our lending over the last 12 months. We continue to refine our credit appetite and our credit policy. But as you've seen, we're very much a prime lender. We've delivered consistently very strong credit results year after year. So we think in that environment, our business can continue to prosper.